this is Bidenomics at work. They've actually massively increased the amount of employment in the public sector. As I said before, I think the public sector is not necessarily the most productive part of it. And this new department, DOGE, is going to look to replace this employment with the private sector. How is that going to happen? We like to think it's going to be done through private sector capital investment. In order for that to happen, I think you're going to see a suppression of interest rate increases. I don't think it's possible that rates can go much higher, certainly the rates that central banks control. And that's because interest costs on the massively expanded government debt are going to be very shortly, if not already, exceeding the defense spending and pretty shortly going to exceed what's spent on Medicare. These are politically impossible levels of interest payments to surpass. And so I think you're going to have to see, rather than the use of interest rates to squeeze inflation, you're going to see a so-called supply side revolution back to the Ronald Reagan era, where massive investments and incentives to invest in the private sector will increase supply and thereby, through increased supply, reduce inflationary price pressure. So this is again is a chart that shows you what's happening relative to the expectations from the Congressional Budget Office, the CBO. You see the actual interest on federal debt, the red line, massively increased relative to the blue line. So what's required, and I don't think it's well appreciated, that private sector jobs and wages matter much more. The top line, individual income taxes, contributes over $2 trillion to government revenues. Corporate income taxes produce less than $500 billion of income. So what you really want to do is to have people working. And I think that's really very important. And so how are you going to get Americans back to work in decent paying jobs? There's the challenge. Now, we don't think it's going to benefit the companies that everyone is in love with. These are the companies, the mega cap companies that are on very high PEs. And you can see the PEs in terms of the purple line. And so we think this policy of America First, or whatever it's now going to be named, is going to benefit very much companies that are in the smaller area. We're well aware of the proliferation of index funds and ETFs. And if you were to look at an index as opposed to the S&P 500, we'd favor you were to look at an index called the S&P 600, which is a collection of smaller companies that will benefit much more from an increase in domestic supply, domestic demand, and re-onshoring, as we expect to happen. So these big stocks are expensive. And it's actually quite true that the big stocks are dominated by exposure to IT. And you can see that the IT market capitalization share of the market, the red line, is much higher than their share of earnings. And typically that will tend to mean revert. Typically the share of earnings, and as it grows, the share of the market cap will grow. But it's quite stretched. Now, it's not as stretched as it was in 1999, 2000. But it is quite well stretched. And so we think there's much better value to be played elsewhere in the stock market.